There's a lot of angry silver people out there now. Still got the rest of June to see where this ends, but that'll be a pullback against that shooting star. And if we get a really bad AI bust, we could come back some way, back to our and bounce and support on our first interim at $40. Our friend Brent Johnson was saying the silver guys are going to lose their heads. Silver's going up to $26. But the big call, you're running 333 once this corrective period is over.
You said 333. Is that what I heard you say?
I think we see a massive loss on valuation on the dollar. First, if we have the AI bust, dollar gets a crisis bid. A lot of other currencies get hit. We get a washout in dollar and debt markets in whatever way they reflate. And I think the precious metals bull resumes. That's when we will run 333, and we also have a single digit gold silver ratio for the final. It made our second interim at the 95 to 103 level. The debt markets will cease to be deemed a reserve asset. Bring you back to the precious metals is gold and silver. So let's talk about the silver market, because we've made big bullish calls there, and there's a lot of angry silver people out there now. There's no such thing as a pullback allowed. And as we said, there's a macro setup on this. So we'll show you this macro setup and draw technically. I'm going to go quarterly just to get a lot of history in here. That'll take us right back to the 80s. We've got to go back to log scale. And here comes your silver chart. And I'm going to just remove a lot of my work but for this indicator. So here's why we say you'll get what you'll get. So HVF method is unique to us. It produces unbelievable targets. It also provides interim targets where the market is likely to rest. And the value of that is that it gives you a key point where you might not want to be leveraged long and aggressively involved. I just need to check that number 4981428. There's one adjustment I have to do for data. 81428. And this is our target and draw for 330 plus target there. So I showed you the Korean one that was showing you 1740, if you remember. So the dollar going to 1740, you're currently at around, to 740. You're currently at around 1520. So 2740, that's still a massive loss, not including overshoot and overperformance. So here's our interim level that was met. And then you got a shooting star there. You can see the pushback and you're getting a red candle afterwards.
Markets celebrate new highs, but seasoned capital pays more attention to where leverage quietly disappears. As Francis Hunt points out here, the bigger signal is not the headline target, but the appearance of interim exhaustion levels after extended momentum runs. Retail investors often treat every correction as market manipulation, while institutions use pullbacks to reduce exposure and preserve optionality. If silver is entering a digestion phase rather than a collapse, positioning discipline matters more than conviction. Next, Francis Hunt reveals why institutional timing around silver corrections rarely matches the story retail investors are being sold.
This is absolutely natural. We've been called it long from 25. Our friend Brent Johnson was saying the silver guys are going to lose their heads. Silver's going up to $26 and pilgrimage there and back again. And we said, no, it's going for the big run, the big breakout, the new highs. And you had only one negative candle on that quarter. So we're on a 3-monther. That's a financial quarter from when that triggered. One positive quarter, 2, 3, 4, 5, 6, huge gaining momentum. 7 positive quarters in a row. No, 7 in total. Wasn't in a row. There was one red one there. Sorry, to be accurate. And then you have, this is a shooting star. It's a blow off. Too much was happening. Little bit of a pullback, and you're getting a red candle so far for this quarter. This quarter obviously ends, June is the last month of the second quarter. So we've still got the rest of June to see where this ends. But that'll be a pullback against that shooting star. And if we get a really bad AI bust, we could come back some way, back to our and bounce and support on our first interim at $40. We could If we don't, or it deflates slowly, this could base a lot sooner. But the big call, you're running 333 once this corrective period is over. So we are massive silver.
You said 333. Is that what I heard you say?
Yes, yes. All the threes, we said,
Got
make
that
it
on
easy.
film. I got that on film.
Yes, indeed, indeed, indeed.
So
This is exactly where momentum investors mistake acceleration for inevitability and give back years of gains. Francis Hunt notes that a market can remain structurally bullish while still demanding painful corrective resets after euphoric quarters. A shooting star formation after persistent upside historically matters less as a crash signal and more as a warning that excess participation arrived too fast. Investors protecting wealth should care less about price targets and more about whether liquidity survives the correction. Next, Francis Hunt walks through the exact timeline when institutional money shifted from momentum to patience and why retail notices too late.
Francis, we talked about gold and silver a bit. We talked about the AI bust. If the AI bust comes to fruition as you fear it might, where do people want to be?
So it's a good question because this could go down first further when things get sold. I will stress the real asset that is capital preservational is precious metals, not the bond market. They will try reposition debt and have people buy back into the debt. We've only finished putting a wooden stake through the 60/40 portfolio as null and void, and that debt is rates higher for longer. I think we see a massive loss on valuation on the dollar. First, if we have the AI bust, dollar gets a crisis bid. A lot of other currencies get hit. Once that bottoms, we get a washout in dollar and debt markets in whatever way they reflate. And I think the precious metals bull resumes. And that's when we will run 333. And we also have a single digit gold silver ratio for the final, call it the top in silver valuations that we would.
333 silver. Francis Hunt, ladies and gentlemen.
Yeah.
Hey,
Yeah.
Francis.
The asset everyone calls safe usually becomes dangerous right when confidence peaks. According to Francis Hunt, the overlooked sequence is liquidity panic first, asset repricing second, and monetary response third. That framework challenges the assumption that bonds automatically protect capital during every shock cycle. Savers focused only on nominal returns often miss how purchasing power disappears long before account balances reflect the damage. Next, Francis Hunt exposes the one metric central banks monitor that suggests protection may matter more than yield.
So, Francis, you're sounding the alarm for a possible AI top, possibly, and Korea being the epicenter that kind of starts to trigger it, or the first sign. And you're very bearish on the won. Now, in terms of the other side, is there anything that you're bullish on, or do you still find that we're in a commodity super cycle? Where are you with what inning we're on, and how much more do we have to go there?
Yes. So anything bullish? Well, dollar gets a bid in what I call disaster or crisis. It's a crisis currency in that sense.
Yeah.
So when you get that collapsing money, you will see a run into the dollar. We are seeing liquidity chase, and we've seen gold, silver sell off. We're seeing the crypto sell off, as I mentioned, and this feels like a liquidity chase. In the longer run, we'll be expecting the gold silver bull to after its break to reassert. And we have huge targets for silver, even though it's trading down at the moment. We have a 333 target. We'll tell you where and why we expected this rest. It made our second interim at the 95 to 103 level. We expected a pause there. We got out of long leverages. We continue to hold our bullion we've bought, but we weren't prepared to trade long anymore. And we had the better part of nearly 50% in correction. You're at 121. And I think we've traded as low at one point as 61. if the AI boom comes and it's very bad, demand destroying, you may have a situation where everything gets sold that isn't nailed down. You could have a further leg down, extension to the existing down leg on both gold and silver.
The market's favorite safe haven often rallies hardest right before confidence breaks somewhere else. What Francis Hunt is highlighting is a pattern where liquidity stress temporarily rewards cash while punishing nearly every risk asset at once. That creates the illusion that the old system still works even as underlying debt pressure builds underneath. Long-term investors should separate temporary dollar strength from actual preservation of purchasing power. Next, Francis Hahn unravels why the official story around liquidity and commodity weakness contains a contradiction most investors never notice.
But once that's done, debt markets, so you asked about calls. One of the big calls we made was the turn in the debt markets. That's the debt markets will cease to be deemed a reserve asset of trust that people will get into. And when we called that, our favorite instrument was the TLT, which is long-term debt. It's an ETF of long-term debt. And we were called short up top here in 2020 September. There was on a low time period, there was our first setup. We said that target, and then you rally for a shoulder, head and shoulder, you come down and you make that target. That target was made roundabout in 22. So we were 2020, late 2020, getting short TLT, and we'd covered by the time it was 2022. Since then, debt has leaked lower, but not single-mindedly. It's gone a little bit sideways down. This is the holding pattern the 10-year has been in, and we say that breaks to the upside for yields, downside for value. So you will reassert to the downside on this TLT and long term, and that's going to be part of the fiat debt collapse that we are warning. So we are in this acceleration, I'd say the Ernest Hemingway's curve, where slowly at first, and then suddenly very fast. We're in that convexity where it goes suddenly very fast. So we're going to roll over on debt again. During this period, the currencies have devalued and taken some of the debt devaluation from around 23 to where we are now.
The market still treats government debt like a safety blanket, even after years of real purchasing power erosion. This is where Francis Hunt's thesis shifts. The bigger risk is not a bond crash headline, but the slow evaporation of trust that happens before price capitulation appears on television. Institutions adjust duration quietly while public narratives keep promoting safe yield. If your defensive allocation depends entirely on long-duration debt, the repricing arrives before the warning label. Next, Francis Hunt exposes the one metric central banks are watching that proves they expect a devaluation cycle, not deflation.
It's been more about currency devaluation, and even the dollar gave up ground against the euro and the pound for a bit as well. But remember, they too are devaluing. What was happening? Gold was going up very strongly. So to me, your unit of account is gold. So that short call on debt was one of the calls. The other one that we did was US oil. When we were at 67, we said, again, I have to take this off log scale because of the plunge, but we were over here that was January 2020 when it finally rolled over. But we were throughout 19 warning that silver, oil was going to collapse further. It's in a huge falling wedge, and we said you're likely to see single digits for the first time in 3 decades. Which is insane because everybody was telling you peak oil.
You said single digits?
Single digits, that's right. And the last time you traded single digits, if I just tidy up a bit, when you're in a range, you broke out about $10 as a currency back here in the 70s. That's when you got out of single digits, you traded through. So 74 through to 2020 is quite some time, 50 years that you hadn't traded. And it actually went, as you're probably aware, cash zero and negative on the futures market.
Yes.
And we recognized that that would bounce as well. You've had another falling wedge and you bounced here. So we are watching oil. It is an interesting energy is a manipulated tool of stagflation.
Markets went up, but purchasing power kept slipping, and most investors celebrated the wrong scoreboard. Francis Hunt's argument suggests that measuring assets in weakening currencies hides structural losses that become obvious only later. The oil collapse and rebound cycle showed how consensus narratives break exactly when positioning becomes crowded and certainty peaks. Long-term wealth protection is less about predicting prices and more about identifying which benchmark is quietly losing credibility. Next, Francis Hunt points out the specific positioning tactic in commodity flows that hides true institutional demand.
So OPEC in the 70s are what America did to debase its debt following the Vietnam War and the closure of the gold window, because France started calling them, printing too much dollars, spending too much money. They were cheating. It was fraud, and they got called on it. So what did they do? They went free float, and so temporary end of the gold window at that point. So we've been in a fraudulent system ever since. And now we're in another debt fiat-based crisis again. And you need the same stagflation. Stagflation enriches the billionaires and impoverishes everybody else. So upper middle class down to working poor. So what actually happens is you technically have a depression. I think we're going to have an extreme version. So rather than a recession, I'm saying a depression on one hand, but a huge devaluation of the fiat as well on the other. So that's the inflation, the loss of buying power of the currency, and at the same time, countervailing force of disinflation, but a loss of jobs, high cost of living, no salary increases. So it's an extreme version of the 70s. And what that does is it enriches the billionaire class, because Elon owns assets, production, and equities, and those things typically hold value when the currency devalues. So they'll go up nominally, but not in real terms. They'll hold their own. But the debt that is used to borrow gets debased away and shrunk right away. So the equity he owns, which is the difference between the debt and the valuation that marks time in real terms, but actually is appreciating in depreciating dollars, means that the billionaires get a whole bunch wealthier. So it is a casino table tilt to one side, and everybody else gets rinsed, and the chips all flow to the other.
This happened before in the 1970s. Nominal wealth climbed while real living standards weakened underneath the surface. According to Francis Hunt, the uncomfortable question is whether policymakers solve debt stress by allowing currency dilution instead of visible austerity. That does not automatically mean collapse, but it does force investors to distinguish rising account values from rising purchasing power. The people who lose most are often those relying entirely on cash flow assets with no inflation defense. Next, Francis Hunt reveals what policy contradictions suggest about the next phase of capital rotation.
Francis, we talked about the yuan being the epicenter. If you can just kind of, and then you fast forward, you talk about liquidity crisis, CBDC being rolled out or accelerated, and then global depression. If you can, first of all, tell me how imminent you think this is, and if you can kind of explain the progression of how things might go in terms of the ripple effect, and like what needs to happen. You said this might be the early sign or the first signal. What might come after, or what's likely to come.
I fear that retail in Korea, both replacing professional money withdrawal, will have a harder time of keeping the Kospi up than the passive buying of ETFs will have keeping the NASDAQ up. That's a personal assessment that I don't have numbers for. That's just hunch. I don't have maths for that. But Korea's a much smaller pond, and keeping up the Kospi requires less resources, but at the same time, there are less people that can get super hyper leveraged beyond what they've already done so far. So my assessment is that you'll start to see newer lows in the smaller market before you see it in America. America is always the last to break in these things. It's pretty good at self-shoring until it can't. And it has, it's better at hiding financial sins for longer. Let's just put it that way. That's not necessarily a compliment or an attribute. So I think the value of Korea is almost like a microcosm of America in a much smaller way.
Nobody's talking about how smaller markets often show stress first because they cannot absorb narrative management for as long. What Francis Hunt is highlighting is not a prediction, but a sequencing model. Peripheral weakness, liquidity concentration, then broader repricing. Macro investors frequently miss this because media attention stays locked on larger indexes until the move becomes obvious. Protecting wealth means watching where pressure appears first, not where headlines arrive last. Next, Francis Hunt unravels why market resilience often depends more on liquidity optics than economic strength.
That we have much less to watch, and we'll see technical new lows there before we see it there, which will give you the early heads up if you want to buy puts or speculate on the downside. And that's probably how I'll play it. I'm also positioning for the damage to the currency, which is something that pretty much, however big your pot is, you can get currencies, you can get pretty levered. You can build big positions on. So if we're right about a near 50% haircut on a currency, that's a huge, currencies don't typically move that. You make a lot of profit on that. So I'm hoping that will be a very profitable trade for us, but I fear it will be a very inconvenient time for South Koreans. It's not popular, and that's going to be inflationary. If your currency halves in dollar terms, that's going to be very inflationary. So Koreans should revisit the era of the Asian crisis and the subprime crisis to remember what happened then. And you'll probably find your jobs markets will turn down at the same time. Ability to get loans will turn down. Interest rates will be punitively high, and a lot of those attributes. All things I still expect to befall America too, but Korea might face it first and harshest as a smaller nation.
If this continues for another cycle, the biggest shock will not be asset prices. It will be how quickly currency assumptions change. As Francis Hunt points out here, markets rarely announce regime shifts in advance. They show up first through financing conditions and capital behavior. Retail hears opportunity, while institutions model survivability under adverse currency moves. The contradiction is that leverage looks safest right before financing becomes most restrictive.